For age pension recipients, selling one home and planning to buy another often raises some big questions. How long do I have to buy the next home? During this transition, am I treated as a homeowner or non-homeowner? And while the sale proceeds sit in my bank account, will my age pension be reduced or even cut off? In this video, you will find answers to those questions and learn how to use a key Centrelink concession to your advantage. Let's get into it. With today's home prices, selling a home before buying the next one can mean hundreds of thousands, sometimes even millions of dollars landing in the bank. Ordinarily, that kind of money would be treated as financial assets, which could easily reduce the age pension or even cut it off altogether. The good news is that Centrelink recognizes this transition period and provides a principal home sale proceeds exemption. This concession is designed to avoid people being penalized simply for changing their principal home. Here's the rule in plain English. After selling a principal home, the portion of sale proceeds you intend to use to purchase, build, rebuild, repair, or renovate a new home may receive concessional treatment. Let's break this down with an example. Say a home is sold for $1.5 million, and the plan is to spend $1.2 million on the next home. Under the assets test, the $1.2 million you intend to use for your next home can be exempt from assessment, but only during the exemption period, which I'll explain shortly. The remaining $300,000, which is not intended for your new home, is immediately treated as a financial asset and included in the assessable assets. Under the income test, during the exemption period, the $1.2 million intended for the new home, if held in a financial investment, is deemed at the lower deeming rate, currently 0.75%. The remaining $300,000 not intended for the new home is immediately assessed as part of your financial assets and deemed under the standard rules, using both the lower and higher deeming rates based on your total financial asset balance. One important detail is that the $1.2 million intended for the new home is assessed separately from your other financial assets. Even though this amount is deemed at the lower deeming rate, it does not use up or reduce the lower deeming threshold that applies to your other financial assets. In practical terms, you still get the full lower deeming threshold on the rest of your financial assets. One key point to remember is that the exemption is capped at the sale proceeds of the former home. So if a home is sold for $1.5 million, but the plan is to spend $1.8 million on the next home, only the $1.5 million, the amount equal to the sale proceeds, can be covered by the principal home sale proceeds exemption. Now that we have covered how the proceeds are treated under the assets and income tests, now let's take a closer look at the exemption period. It usually begins on the settlement date of your former home. It ends when the earliest of the following occurs: the settlement date of a new home, or the move-in date if the new home involves building, rebuilding, repairing, or renovating. You no longer intend to buy a new home, or after 24 months. Although this can be extended to up to 36 months in special circumstances, which we will touch on later. But how are you assessed during this exemption period, as a homeowner or non-homeowner? The answer is you will continue to be assessed as a homeowner throughout the exemption period. That means Centrelink continues to apply the homeowner threshold when assessing your pension entitlement. These thresholds are lower than those for non-homeowners, but that's understandable since the portion of the sale proceeds intended for the new home is already being exempt from the assets test. If you like a copy of the latest threshold, you can download them for free using the link in the description below. Normally, being assessed as a homeowner means there is no access to rent assistance. However, during the sale proceeds exemption period, even though you continue to be assessed as a homeowner, rent assistance may still be payable if you're renting. The amount of rent assistance you can get depends on how much rent you pay. There is a minimum amount of rent you need to pay to get rent assistance. For every $1 of rent you pay above this limit, you will get 75 cents. You can't get more than the maximum amount. Hi, if you're getting value from this video so far, please take a moment to like and subscribe. It helps the channel grow and keeps me making more content like this. Thanks so much. From what we have covered so far, you have probably picked up that the word intention is key. Only the value of principal home sale proceeds that are intended to be used to purchase, build, rebuild, repair, or renovate a new principal home qualify for concessional treatment. I have intended to go to the gym 5 days a week for the past 5 years, and that hasn't happened. So quite often, intention and reality don't match. The first common question is, does Centrelink require proof upfront that my intention will actually happen? The short answer is no. You have the obligation to inform Centrelink of the sale of your former home within 14 days of the settlement date. And that's when you will also declare your intention for the sale proceeds. Centrelink doesn't require proof in advance. The intention is declared, not pre-approved. Another common question is, what would happen if the final purchase price ends up being different from what was originally intended? For example, someone told Centrelink they intend to spend $1.2 million on a new home, but later found a suitable property for $1 million and went ahead with the purchase. In practice, as long as the intention was genuine at the time, and that was amount advised to Centrelink, the exemption applies to that intended amount. Centrelink generally won't go back and reassess or claw back payments if you don't end up using the full amount. Similarly, if that person ends up spending $1.3 million after originally telling Centrelink that intended to spend $1.2 million, that won't be reassessed, and that won't be compensated for any age pension that would have received based on the higher amount. Those situations generally cover cases where the original intention stays the same, even if the final outcome looks different. However, if the intention itself changes, whether that means planning to spend more, spend less, or no longer intending to purchase a new home at all, it's important to notify Centrelink within 14 days. Earlier, I mentioned that in some cases, the sale proceed exemption period can be extended beyond the standard 24 months to up to 36 months. To qualify for the extension, specific criteria must be met. The person must have a continuing intention to apply the proceeds of the sale to purchase, build, rebuild, repair, or renovate a new principal home, and also have made reasonable attempts to do so. The Social Security Guide includes clear examples of what Centrelink considers reasonable attempts. You'll find the link in the description below. Feel free to check it out for more details. Making those attempts within a reasonable period after selling the principal home. This is usually 12 months from the settlement date. Experienced delay beyond their control in purchasing, building, rebuilding, repairing, or renovating their new principal home. Examples of these include delays in obtaining council approvals, prolonged illness or hospitalization, or widespread building delays caused by events such as floods, bushfires, or other natural disasters that make it impossible to secure a builder or progress the work. Importantly, all of the above criteria must be met. If one of the above criteria is not met, then you cannot gain an extension. Centrelink makes it clear that extensions are assessed on a case-by-case basis, so it's important to speak directly to Centrelink or seek professional advice to get guidance tailored to your specific situation. If this video is helpful, the next one will be a great follow-up. In the upcoming video, I'll be covering downsizer contribution, how they work, who is eligible, and how they fit in after selling a home. So if selling a property is on the radar, make sure to watch that one as well. Thanks for watching. I'll see you in another one.